Tom Lee just dropped a bombshell on CNBC. There's $7 trillion in cash sitting on the sidelines and a rally is coming. That's right, 7 trillion with a T. While headlines are buzzing about Moody's downgrade of the U.S. credit rating, Tom Lee from Fundstrat says it's all just noise. The real story? There's a massive wall of cash waiting to flood back into the market. And when it does, things could explode upward fast. In this video, I'll play you the key moment from Tom Lee's CNBC interview. Then I'll break down exactly what it means for your money. And I'll reveal one stock that could make you a fortune as this potential rally unfolds. If you only watch one investing video today, make it this one. Watch it all the way through so you don't miss a critical piece of information. Tap that like button. Let's see if we can hit 1,000 likes on this one. Drop your thoughts in the comments. I want to hear what you think about Tom Lee's call, and don't forget to subscribe so you never miss a big financial move. Alright, let's dive in and hear exactly what Tom Lee had to say.
Today's pullback comes after a standout week for the bulls, of course, which saw the S&P jump more than 5%. Joining us here at Post 9 is Tom Lee, Fundstrat Global Advisors Head of Research and Fundstrat Capital CIO. Happy Monday, Tom. Good to see you in.
Yeah, happy Monday.
You really haven't been unnerved by anything since Friday night, have you?
No. I don't know if there's much signal in the downgrade Friday because I think the first AAA downgrade was signal from 2011. I don't think Moody's had any information that we didn't have on Friday afternoon, so I think markets should realize the bond market largely priced in the fact that the U.S. is really not AAA anymore. So I'd be viewing this as a buying opportunity.
That said, you're not discounting the notion that the vigilantes have been reawakened a bit?
You know, I think everyone should be aware the U.S. has an unsustainable path for debt, but I think the real signal will be when an auction fails. That happened a few years ago, and then we realized that was the time to really pay attention to the fact that we have debt sustainability issues. But I think a downgrade itself, I don't think it is much signal.
So we reclaim the 200-day. Is that a clear path to a new high, as some of the trading desks suggested this morning?
Yeah, in fact, I think today will be an interesting test. I'm assuming today's pullback is going to be really shallow, might even close positive, because most investors rage sold at the bottom in April, and then they doubted.
I hadn't heard that.
Yeah,
that's a good one. Is that your own, or have you heard that other place?
I've heard that. Yeah,
rage sold.
Yeah.
Sorry, go ahead. Continue.
And so as the markets climb, a lot of people sort of doubted, thought it was a rally that would fail, and so I think there's $7 trillion cash on the sidelines, enormous skepticism from our institutional clients, and a lot of folks sort of bet outside the U.S., so I think there's going to be a lot of chasing into year-end.
Although, a lot of shorts have been covered already, though. A lot of the hedge fund guys who actually got it wrong and rage sold, to your point, are in a very different position right now in terms of positioning.
Yes. No, and there's a difference between being short and versus having positive beta to risk assets. So I think most people might be flat on their books. But if the market is above its 200-day, showing this sort of impulsive buying, and you're flat, that means you're underinvested.
How are you evaluating potential changes in tax policy? Obviously, the market has been very reactive to any headlines on tariffs. What about this one?
Yeah, in fact, I think as we start to think about 2026, and it makes sense because we're in the mid-year, there is not only tax policy that can be a tailwind, it looks like it's going to be, but it's deregulation.
Sure.
I mean, several published pieces show that regulatory cost for U.S. companies is over $2 trillion, maybe as much as $3 trillion. It's a bigger deal than the tax cuts itself.
Yeah, obviously we've been waiting for some time about the regulation. So in this environment, the ever bullish Tom Lee, what are you looking at when it comes specifically to the Magnificent Seven? We watch those so carefully, but the NASDAQ, of course, under pressure here today.
We think the Mag 7 is going to lead into year end because it's a group that fell first. It was widely owned, but it really got washed out. I think Tesla was a really good sort of case study. So I think the Mag 7 is going to reclaim its old highs. That's, of course, why the S&P should regain its old highs and of course, actually move above that before year end.
And what about financials? That's obviously an area that so many people were looking to early on. Is that still on your radar?
Yeah, financials are important. You need the banks to rally. They have been. If I was going to make a case for multiples expanding, financials is one place because not only did they prove themselves actually pretty resilient during Fed hikes and during this turmoil, but they're kind of more tech-intensive companies with better credit profiles. So I think multiples should go up.
If we do revisit the highs, what needs to happen to push past that? I mean, how firm of resistance will it be?
Well, I think investors have to look past tariffs because if we're only trading tariff headlines, the markets are going to be range-bound. But again, as I look at 2026, I'm looking at companies that are battle tested. They survive the tariff headlines. There might be freer trade. That's an upside to earnings.
Freer trade than we thought.
Yes, than we thought, yes.
But earnings estimates have come down, have they not?
Yeah, but they're going to flex in both directions, meaning I think if we have deregulation, possible improved ability to export, tax cuts, that actually all supports higher earnings. But I also think the multiple for the S&P should be going up because, again, we've taken away a black swan event. I mean, we did, the February to April period was a black swan for stocks.
Do you think the downgrade hurts the push for tax cuts?
I think it's going to have almost no effect.
No effect?
Yeah, because at the end of the day, the bond market prices what they think the rating should be.
I don't mean from the market standpoint. I mean from the political optics standpoint.
Yeah, it might, but at the end of the day, the U.S. really wasn't AAA anymore because it was only 1 out of 3, so it's like not even a split rating AAA.
So, Tom, is there anything out there? I mean, and to be fair, you've been bullish throughout. You were right during this period when a lot of others sort of, whether they rage sold or just got upset in general. But what, if anything, is top of mind for you in terms of a concern?
Well, I think the most important is the consumer has to stay healthy because right now we're seeing this huge divergence, right? Like the UMich surveys show banana-level inflation expectations, but the realized is low. If the consumer gets super cautious and retraces, then we have a recession. So I think it does come into consumers have to stay confident and keep their jobs.
And so you're a believer in the data versus the sentiment?
Yeah, at the moment, this divergence between inflation and realized is actually the largest, I think, ever recorded for UMich. And so I would say as long as inflation doesn't explode, then the consumer has marginally a chance to become even more positive.
Wow.
Yeah, a lot of your former colleagues at JPM think that the hard data will catch up to the survey work.
Yes. And I'm paying attention because, of course, JP Morgan, they do a lot of homework and they've got credit card data, so we do have to watch it.
Sure.
So we just have to hope for the best.
Tom, always. Good to see you. Thanks.
He's
Tom,
always
thank
less
you.
helpful.
So first off, Tom Lee addresses the elephant in the room, the recent U.S. credit rating downgrade. And what's interesting is how unfazed he is by it. He basically brushes it off and says this isn't anything new. According to Tom, the bond market had already priced in the reality that the U.S. isn't truly a AAA credit anymore. He even compares it to the 2011 downgrade, which was more of a signal event. This time, it's just noise to him. What he's saying is, don't overreact. In fact, he sees the market dip that followed as a buying opportunity. Classic Tom Lee, always looking for value in the chaos. But then, he acknowledges something a bit more serious. The risk of bond market vigilantes. The idea that investors might eventually rebel against government debt if things get too unsustainable. That is a real threat, he says, but not triggered by the downgrade alone. The real alarm, according to him, would be when a treasury auction fails. That's when we should really start worrying about debt sustainability. So, bottom line from this part, ignore the downgrade headline. The market already has, but keep your eye on the bond market for real warning signs. Next, Tom dives into what's been happening in the equities market. And here's where things get super interesting. He introduces this term, rage sold. Basically, he says a lot of investors dumped their stocks in anger or frustration during the market bottom in April. And now, they're sitting on the sidelines in disbelief as the market rallies hard without them. Think about that. Over $7 trillion is sitting in cash on the sidelines. That's massive. And Lee believes much of that cash is going to chase the market into year-end as people try to get back in. So despite today's pullback, Tom sees the dip as shallow and temporary, with a real potential for the market to close positive, because so many people are underinvested and afraid of missing out. This also ties into his view on investor sentiment. There's still a lot of skepticism out there, especially from institutional players, and that skepticism to him is bullish, because it means there's more room for the market to go up as those investors eventually pile back in. Tom then pivots to one of the hottest topics in the market, the Magnificent Seven. You know, those mega-cap tech names like Apple, Microsoft, Nvidia, Meta, and Tesla. He believes this group will lead the market higher into the end of the year. His logic? These stocks were the first to fall, and many of them have been washed out of over-ownership. He singles out Tesla as a case study, suggesting it's a poster child for a comeback. And if the Mag 7 reclaims their highs, the S&P 500 is going to do the same, and even break out to new highs before year-end. So while the Nasdaq may look shaky now, Lee's view is that these names will regain strength and drive the overall market forward. Next up, financials. often overlooked, but still critical to the market. Tom points out that banks have been resilient, despite rate hikes and macro fears. And interestingly, he believes banks today are more tech-intensive than people realize and have better credit profiles. Because of that, he sees potential for multiple expansion in the financial sector. In simple terms, he thinks investors will be willing to pay more for bank stocks in the near future, pushing their valuations and prices higher. This is a subtle but important take, because financials have been lagging, and a rotation into them could be a sign of a broader rally. Now, here's where Tom starts getting a little more long-term. He's already thinking about 2026. Yeah, 2 years ahead. And he sees major potential tailwinds, not just from possible tax cuts but from deregulation. Tom says that regulatory compliance costs for U.S. companies could be upwards of $2 to $3 trillion. So rolling back some of that burden would be a bigger deal than even tax cuts. This is a huge insight. If deregulation happens, it could significantly boost corporate earnings and market sentiment. Lee also addresses trade, specifically tariffs, and their impact on market behavior. He warns that if investors keep trading every tariff headline, the market could stay range-bound. But he sees opportunity beyond the noise. If companies have survived the tariff era, they might thrive in an era of freer trade, which he sees as a potential surprise upside heading into 2026. He also discusses earnings estimates, saying they've come down, but that's okay. Because with deregulation, tax changes, and improved exports, earnings could move back up. And he believes the market multiple, or how much people are willing to pay for stocks, should also rise. Then he drops a big statement. The volatility from February to April? That was a black swan event and we've moved past it. That's why he's comfortable with a higher multiple going forward. Back to the downgrade. Will it hurt chances of tax cuts? Tom says not really. Politically it may cause some noise, but the bond market isn't reacting dramatically, and that's what really matters. But when asked what he's most concerned about, Lee finally admits a genuine fear, the consumer. Right now, there's a weird disconnect. Surveys say consumers are afraid of inflation, but real inflation is actually pretty tame. If that disconnect widens and consumers start retrenching, meaning pulling back spending, that could trigger a recession. So as bullish as Tom is, he's keeping one eye on the consumer, because if the job market weakens or people stop spending, that's when trouble starts. So, that's the full breakdown, guys. Tom Lee is still one of the most optimistic voices on Wall Street. But it's not blind optimism. He backs it up with data, history, and some very strategic thinking. He sees through the noise, like the downgrade, and focuses on the bigger drivers: consumer strength, cash on the sidelines, deregulation, and global trade. If he's right, and let's be honest, he's been right more than wrong lately, we could see a strong finish to the year and an even stronger setup for the next couple years. But what do you think? Is Tom being too optimistic? Or do you agree that the market is setting up for a big leg higher? Let me know in the comments below. And don't forget to like, subscribe, and hit the bell so you never miss a deep dive like this one. Now let's talk about the one stock with a huge potential to make you a fortune in a short period of time: SoFi Technologies, ticker symbol SOFI. This isn't your grandfather's bank. SoFi is a digital-first platform, offering everything from banking and investing to loans and insurance, all in one convenient app. SoFi is all about financial inclusion and empowerment. They're using technology to simplify finance, making it accessible to everyone. And the numbers speak for themselves. SoFi's innovative approach is clearly resonating. The company has managed to carve out a unique space in the financial technology sector, leveraging cutting-edge technology and a customer-centric approach to redefine how people manage their finances. From personal loans to investment opportunities, SoFi offers a comprehensive suite of financial products that cater to a wide range of needs. This holistic approach has not only attracted a diverse customer base, but also fostered a strong sense of community among its members. They've witnessed a staggering 172% surge in net revenue from 2021 to 2024. This remarkable growth can be attributed to their relentless focus on innovation and customer satisfaction. By continuously enhancing their product offerings and expanding their market reach, SoFi has managed to stay ahead of the competition and deliver exceptional value to its stakeholders. Their membership base has skyrocketed tenfold since 2019, reaching an impressive 10.9 million members. This exponential growth in membership is a testament to the trust and loyalty that SoFi has built over the years. By offering personalized financial solutions and exceptional customer service, they have managed to create a loyal and engaged community that continues to grow at an unprecedented rate. And the future looks even brighter. With a strong foundation and a clear vision for the future, SoFi is well positioned to capitalize on emerging opportunities in the financial technology space. Their commitment to innovation and excellence ensures that they will continue to lead the industry and set new benchmarks for success. Analysts project a phenomenal 19.8% compound annual revenue growth rate for SoFi from 2024 to 2027. This optimistic projection reflects the confidence that industry experts have in SoFi's ability to sustain its growth momentum and continue delivering exceptional value to its customers and shareholders. This company is on fire. With a proven track record of success and a clear roadmap for the future, SoFi is poised to achieve even greater heights in the coming years. Their unwavering commitment to innovation, customer satisfaction, and community building sets them apart as a true leader in the financial technology space. As they continue to push the boundaries and explore new frontiers, there's no doubt that SoFi's growth trajectory will remain on an upward path, inspiring confidence and excitement among all its stakeholders. With a market cap of $15.18 billion, the company posted earnings per share of 44 cents, supported by a price-to-earnings ratio of 31.23. Revenue for 2024 came in at $3.77 billion, and net income soared to nearly $499 million, a massive leap from previous years. One of the biggest indicators of SoFi's turnaround is its profit margin, which jumped from negative 10.3% in 2023 to a solid 13.2% in 2024. That's a clear signal that the company is not just growing, it's becoming more efficient and more profitable. Return on equity landed at approximately 8.3%, based on nearly $500 million in net income and an average equity base of $6 billion. Meanwhile, SoFi's debt-to-equity ratio has improved significantly, falling from around 0.94 last year to just 0.47, a sign of declining leverage and strengthening financial health, and investors are paying attention. In the weeks leading up to May 14th, SoFi's stock price surged by 47%, reflecting renewed investor confidence and momentum. Analysts are particularly bullish on the company's financial services division, which has doubled its revenues year over year. With goals of boosting membership by 30% and revenue by 20%, analysts have set a price target of $15.93 for the stock, a mark that suggests more upside potential ahead. Beyond the financials, SoFi is also stepping up its community involvement. The company recently partnered with country artist 𝗗𝗟𝗏𝗧 and the nonprofit 𝗍𝗟𝗓𝗡 to invest $2 million into programs helping Tennessee students achieve financial independence. It's a smart move that not only enhances SoFi's brand image, but also builds trust among younger users, their future customer base. Their Q1 2025 earnings results were particularly eye-opening. SoFi more than doubled profit estimates and reported a staggering 200% year-over-year increase in non-GAAP profits, proof that the business is firing on all cylinders operationally. Now, while the market remains cautiously optimistic, and some concerns still linger about valuation and recent price fluctuations, SoFi's current trajectory looks strong. The company's shift to profitability, expanding margins, and lowered leverage suggest that this isn't just hype, it's a real business gaining real traction. SoFi's digital-first model gives it a moderate competitive edge, and its growth metrics are undeniably solid. However, a few cautions remain. The company still faces some geographic concentration risks, and it hasn't yet introduced a significant stock buyback program, which could limit shareholder returns in the near term. Still, based on current performance and future projections, SoFi earns a resilient outlook, showcasing strong fundamentals with room to improve on diversification and return strategies. In today's fast-paced world, staying informed and educated is crucial to making smart investment decisions. By understanding market trends, economic indicators, and financial statements, you can position yourself to take advantage of lucrative opportunities and avoid potential pitfalls. That's why I'm thrilled to introduce my Value Stocks Investing Master Course, designed to equip you with the tools and strategies to navigate the market like a pro. This comprehensive course covers everything from the basics of stock market investing to advanced techniques used by professional traders. You'll learn how to analyze financial statements, understand market trends, and develop a personalized investment strategy that aligns with your financial goals. Whether you're a seasoned investor or just starting, this course has something for you. For beginners, we'll cover the fundamentals of investing, including how to open a brokerage account, the different types of investment vehicles available, and the importance of diversification. Learn to identify promising companies, manage your portfolio, and maximize your returns. We'll teach you how to conduct thorough research on potential investments, evaluate a company's financial health, and determine its growth potential. Don't miss out on this chance to level up your investing game. Investing in your future is one of the most important decisions you can make, and this course is designed to give you the knowledge and confidence you need to succeed. Click the link in the description and pinned comments to join us today and start your journey towards financial independence and success. Remember, the best investment you can make is in yourself. Want to dive deeper into the world of investing and gain access to exclusive insights, analysis, and community support? Join my Patreon community today. As a member, you'll receive exclusive content, participate in live Quanda sessions, and connect with a network of like-minded individuals passionate about finance. It's time to take your investing journey to the next level. There you have it. SoFi Technologies is a force to be reckoned with, and they're just getting started. This is your chance to be part of something big. Like, comment, share this video with your friends, and subscribe to my channel for more insightful content. Let's ride this wave of innovation together. See you in the next one.